This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Joining us in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Simon's picture that says looking for the downloads. Now, Eric, let's start off by covering crude oil, starting with the EIA inventory data.
EIA printed a drawdown of 2.2 million barrels of crude oil nationally, and that's in addition to another 0.3 million barrels that was drawn down out of the Strategic Petroleum Reserve. Now, I know what you're thinking. Wait a minute, that must be backwards because the Biden administration promised us they'd be refilling the Strategic Petroleum Reserve right about now. I think what it is in Bidenomics, what they're doing is they're refilling it every week. They just happen to refill it with a negative number this week. That's all. Nothing to see here, folks. Keep moving. Cushing, Oklahoma, drawing down 943,000 barrels. Not quite a million barrels. Doesn't sound like that big of a drawdown, but on a percentage basis of what's left in those tanks in Cushing, it's absolutely monumental. Cushing cannot last much longer with all of these big drawdowns, and that's the reason that we're seeing this explosion in the WTI time spreads. And finished products were the builds on the board, with gasoline building 1 million barrels and distillates building 398,000 barrels. U.S. production held steady at 12.9 million barrels. Yet another example this week of an overbought market dipping far less than expected and then powering higher much sooner than expected. The term structure is absolutely exploding upwards. This is the biggest move since February of 2022 when the Ukraine invasion began. That probably begets the question, okay, does that mean that the market is signaling that there's, some new war escalation coming? No, it doesn't mean that. What it means is that the market is scared to death that there's a possibility it might not be able to settle the November or December WTI crude oil futures contracts. The reason for that is because the inventory has been drawn down to such ridiculously low levels. So it's because of that extremely low inventory level in Cushing and elsewhere that I think this is happening. The market could be smelling out geopolitical risk as well, but one way or another, we're seeing a blowout in the term structure that is usually a very bullish sign for the flat price. We have to be careful to say that here because we're already pretty seriously overbought on the flat price, really right at the top of the channel that the market has been tracing, and a lot of people are saying that channel is just frightfully steep already, thinking it might break down to the downside, but it almost seems to be breaking to the upside. So what's driving this? How much farther does it have to go? We'll find out, but this market couldn't look a whole lot stronger. Big question is just looking this overbought. Surely there must be a pullback coming, right? Well, how many times have I said that in the last 3 weeks?
So on page 2, I have that crude oil chart, and when I overlay this 50-day moving average on there, you can just see how clean of a breakout this entire last 2 months or month and a half has been for crude oil. We've been now in almost a 1-year bear market in crude where it decisively remained in a primary downtrend, and we have now cleared the highs from October and November of last year and really started to see the pattern of higher highs, higher lows, staying above the moving averages. Crude oil is really going. Now, to me, there's 2 really important hurdles for crude oil, and they're the fib zones that lie more or less in this $94 area and this $100 area above. The 100 is also obviously a key psychological factor. You're going to certainly get a huge number of headlines amongst all the major financial media outlets when the $100 level is hit on crude. I think both of them are reasonable targets here as the momentum in crude simply has not given out. The bigger question in my mind is that really bull scenario, that one where Goldman Sachs just came out with a $150 target. Are we seeing this begin a substantial new primary trend that will last the remainder of the year and keep or even head right back to the 2022 highs. I'm a little bit cautious of making that bold of a call here. Right now, I think this approaching the upper targets toward 100 is a very realistic short-term target. And then I want to really see how the price action settles in. And if it looks really good, I think looking for continuation patterns will make a whole lot of sense. Now, let's move on to equities. And this is, Nick, where I want to get you involved. It's been a while since we got an update from you. So let's talk the S&P 500. What levels are you watching?
Spot price right now is approximately 42.80 on SPX. We have a call wall above at 43.50 and a put wall far below at 4,200. The implied move for the October 20th monthly OPEX is plus minus 140 points. So the expected move to the upside would be 44.20, and the move to the downside would be 41.40 approximately. Now we have key resistance just above at 4,300, key support just below at 42.50, which was tested yesterday, and then support just below that at 4,200. Given that we're down about 8% from the year highs, I'm inclined to think we see some more pain ahead, possibly some dead cat bounces toward that 43.50 area, but I'm not so bullish right now. I'm pretty bearish, and I may be late to the party perhaps, but I do think we're going to see some more downside. I don't see an impetus to hold equities right now given the risk-free rate. What are your thoughts?
Well, you know what? I agree with you in the sense that I think the highs of the year are likely in. Obviously, with only one quarter left, it would take a lot of bullish conditions for us to be clearing those 4,600, 4,700 highs that were put in the summer. But the bigger question is if and when are we going to see bigger downside? I think what's going to be really interesting is we have that JP Morgan whale with that collar rolling off at the end of this week. And right now, that 4,200 strike where a lot of the open interest is on there was been acting like a bit of a magnet. The bigger question for me is, will that cause the reflexive rally? And while you were talking 43.50, I think we can easily have 100 to 150 point rally that basically is just unwinding this incredibly short-term oversold market. But like you were suggesting, I think all rallies will be easy to fade. I think that at this point, short-term rallies should be sold, and I think that's going to be the trend moving forward. Nonetheless, Nick, let's talk the Nasdaq. Obviously, the relative strength of the Mag 7 have held this up better than other charts. What's your thoughts, and what are the levels you're watching?
Spot price right now in Qs is about 356. We have a call wall above at 370 and a put wall just below at 350. Key resistance above is at 370 and then 380, and then key support just below at 350. The implied move for the October 20th OPEX is plus minus 16 points, which puts our upper expected move at 372 and our lower expected move at 340. Again, I'm pretty bearish right now because I'm looking at names like Amazon and Microsoft, which are breaking down to new lows. Microsoft right now is below its 3-month low. Amazon is testing lows, recent lows. And then you have Apple as well, which is breaking to new lows as well. So seeing the big names fade down doesn't give me much confidence in broad markets because right now, 7 names account for about 50% of the gains we've seen in the markets over the past year, whereas the remaining 493 in the S&P have accounted for about 5%. So without those big names rising up, it's hard to see a push upward. And again, you said previously that you see a rally perhaps, and I do see that we may have some of these dead cat bounce pops where we pop 100, 150 points over the course of a few days. That's indicative of what happens during a higher volatility market.
Well, speaking of volatility, I think that's exactly what we need to talk about. Earlier, Simon White was talking about dispersion in returns as being a contributor to keeping vol conditions pretty low. I suspect another contribution to that has to be a lot of the short gamma overwriting that's occurring by a lot of participants who see only limited upside potential, keeping an ample supply of that short gamma up there. And the thing is that I think has suppressed volatility. To me, I find it really surprising that we're at these levels because the last time we had a 300 plus point drop was during February-March sell-off where obviously regional banks were under a lot of stress. I mean, we were seeing the VIX approaching 30 on the upper end. Here, I'm surprised that we have not seen the aggressive selling spur the animal spirits that are driving high volatility premiums. And it'll be really interesting to see, can we see a short-term swing bottom occur without a VIX printing above the 20 handle? To me, I'm seeing this as a strange divergence in the market, but I'll tell you, in order for us to see the end of this swing trade sell cycle, even if there'll be dead cat bounces, I think we need a little bit of more of a spike in vol premiums as there's going to be a little bit more panic. I mean, the unwind of these vol targeting funds and other types of products, including right now, is where a lot of trend following methodologies will start to flip short on the downside of the market. And this is the kind of selling that spurs on margin calls. And so I think that you're bang on. We're going to see definitely failed rallies, but I think there's more to come. But what do you make of this VIX?
So right now with the VIX at around 18 or so, we expect about 1.2% moves in broad markets each day. And what I'm looking at is that, I'm thinking about this in a broad sense, in that larger equity holders are not trying to offload their equities in one fell swoop so as to fire sale stock prices. And by doing so in a gradual manner, that suppresses volatility. Additionally, if people don't plan, and I mean, I want to say people, I mean market participants, if participants don't plan on holding equities longer term, the demand for hedges in the form of puts is also suppressed. So that can kind of keep volatility dampened as we decline in a gradual fashion. Like yesterday, for example, we're down about 1% at the lows, yet the VIX wasn't spiking too heavily, which is very, very surprising, right? But I do think that this lack of demand for equities going forward over the next perhaps 6 months or so would suppress the demand also for insurance in the form of puts, which will also suppress the VIX perhaps. Now, moving on to page 7, we have the US dollar index. What are you guys thinking here?
Well, guys, I'm getting concerned. Brent Johnson's scenario of a retest of 115 on the Dixie is looking more and more realistic every day. And as I look at this chart, it doesn't seem to me like there's any technical reason to doubt that possibility. And using just a very simplistic measured move analysis, it looks to me like a break above 115 should take the Dixie to 122 or so. Now, I don't profess to be expert enough to know the full details, but what I will say with strongest conviction is if the Dixie hits 122, a whole lot of other shit is going to break, starting with EM debt. And EM debt would just be the first domino to fall. I'm not making any prediction that the Dixie is going to get to 120. I really thought 115 was going to be it. But what I do predict is that if the Dixie moves over 120 and stays there, the longer it stays at those levels, the more EM defaults will develop contagion to other markets, and it won't be pretty.
Yeah, Eric, clearly this is a bull breakout. The bigger question in my mind is how much does it accelerate? How much does it gain traction? I mean, those previous highs on the US dollar yen near 150, 152 are certainly going to be an obstacle. But if we see, the US dollar clear those levels, at the same time, a euro that's breaking below this like 105 level, heading down towards parity, like if we see these types of feedback mechanisms get going, that could really accelerate the dollar, which would create its own feedback mechanism, and that could certainly be a contributor to sending this risk-off message throughout the entire marketplace. To me, this is a very clear new bull trend in the dollar. We've clearly beat a lot of important hurdles. And to me, what will be the real test is going to see how traders behave during a short-term pullback. Like, let's say we have a quick drop on the dollar index towards 50-day moving average near 104. Will it be aggressively bought on dip? Will we see it work its way quickly right back to the previous highs? We're going to be watching that price action to really see whether or not this continues. But right now, it's very hard to take any position other than looking on for a little bit more strength in the dollar in the short-term period to come.
Now on page 8, we have the gold futures chart. Eric, what are your thoughts here?
Well, obviously, it's a bloodbath over the last few days, but this should come as no surprise to MacroVoices listeners. As we've been telling you for the last several weeks, there's good reason to think that rates will stay higher for longer and that the dollar might continue to strengthen as it has. We told you if that happened, gold would be in trouble. And if it broke its 200-day moving average to the downside, you could see a big acceleration as everyone panics at the same time. Well, that's exactly what's happened in the last few sessions. The good news is that if you do a comparison to the Dixie, the last time the Dixie was this high, the spot price of gold was much lower. And even using the contract chart, using the December contract chart rather than the continuation chart, Wednesday's price is still just barely above the March lows, when the Dixie peaked at a lower level than it closed on Wednesday. So the point is, despite the selling, gold has been more resilient than one might expect on a correlation basis. I remain steadfastly convinced that the trade of a lifetime is to go long gold with leverage the day before the Fed really and truly does reverse course and pivot dovishly. I still think that's quite a few months off, so I'm not expecting any new all-time highs this year. But I do expect that the bottom of this correction could come this year, and I hope I'm lucky enough to lever up there. When the Fed ultimately is forced to cut rates, gold is going to soar. But I don't think that's a 2023 story. I think it's next year.
You know, Eric, I don't make this much more complicated. To me, I look at gold as a cross currency to the U.S. dollar, and I understand real yields and other things like this obviously contributors to the trends. But to me, in a period where the U.S. dollar strength is prevalent, then it's going to be a drag on gold prices, and that's what we're witnessing here. And at this moment, with this breakdown, while there's some short-term support lines in the next 50 or so dollars lower that could create a bounce or a reaction, I think that generally the time for gold to shine is going to be a little bit later in the year or even in the first quarter, once the market starts getting a hint that maybe an easing cycle might be actually sooner than everyone expects. But right now on the short term, with the dollar doing what it is, it's a lot more of the same. I don't think there's going to be a huge downside. I don't think that gold's going down to 1,600, but there's certainly no indication that a new bull trend or an accumulation cycle has begun. And so temporarily, you're going to have to stay underweight and hedged gold until the next buy signal gets underway. Nonetheless, Nick, I wanted to wrap up here with looking at three charts. I wanted to look at the copper chart on page 9. And what we continue to see is copper remains structurally weak. Lower highs, lower lows, working its way down. This is in line with generally global economy that is contracting and relatively weak. And while I remain big picture very bullish copper, on the very short term, this is a chart that typically would break down. And seeing copper go to 350 and even retesting the October of last year lows near 3.25 are entirely possible, especially if we see all broad assets in some sort of a risk-off cycle. But on page 10 is the single most bullish area of the market right now, which is uranium. And the U308 north of 70 on the upside. They're all clearing multi-year highs. And more importantly, this is almost becoming a parabolic rise on the upside. Now, I tend not to want to encourage people to be buying rips. I prefer buying dips. But this is a very hot market. And what I think is that when it does dip, it will probably be very short and fast. And it'll be really interesting to see how fast the bulls come right back in there and buy that dip. So uranium's just staying super bullish. Now, the final chart I wanted to look at was that 10-year US Treasury yield. And while I was trying to be optimistic that the previous year highs were going to hold, it is clear that the bond market has some more selling to do. It's amazing that we're at 460 in this type of an environment. While will we see 5%? I mean, there's a chance that we can get to 470, 480, and this trend continues for several weeks. But my gut feeling is that we may not make it all the way to the 5% level. But clearly, that's speculation at this moment. I'm watching this closely to see where this peters out and where a potential bond bottom may start to form.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.